Okay, it's Friday, May the 9th, 2025. Welcome, everyone. Welcome back to the FinWell Daily Brief. This is our 35th installment.
Great to be here.
And let's dive right in with our financial fact of the day. This comes straight from SEBI's 2025 report, and it's quite something.
Oh, what have we got?
Get this. Over 75%. That's more than 3 out of 4 retail investors here in India. They're holding their equity investments for less than 2 years.
Wow. Less than 2 years.
Less than 2 years. It really, makes you stop and think, doesn't it?
It certainly does. In a market that's often touted for its long-term growth potential, that's a very short holding period.
Exactly. So the big question is, what does this sort of short-term focus actually mean for the average Indian investor trying to build, lasting wealth?
It potentially points towards more of a trading mentality than a long-term investment approach, maybe driven by, information overload or the chase for quick profit.
Could be. It definitely sets the stage for what we saw in the markets today. Let's get to those closing numbers. The Nifty 50, it finished the day at 24,800. That's down 265.80 points, or 1.0%. A noticeable drop.
Yeah, over 1% for the main index is significant for a single day.
And looking broader, the Nifty Midcap 150 ended at 19,596 under 225. Interestingly, down only slightly, 4.45 points, basically flat at minus 0.02%.
So the midcaps held up much better.
They did. Then the Nifty Small Cap 250, that closed at 15,080.45. It was down 100 points, which is about 0.66%.
Okay, a bit more pressure on the small caps and the mid caps, but still less than the large caps in the Nifty 50.
Precisely. And the Nifty Total Market Index, giving us the overall picture, closed at 12,168.05, down 91.0 points, or 0.74%.
So definitely a down day across the board, but the real drag seems to be coming from those top Nifty 50 stocks.
Yeah, that's the key takeaway. The large caps took the biggest hit.
Which usually suggests that whatever is driving the market sentiment today, it's particularly affecting the big established players. So what's the story?
Well, the main narrative, the elephant in the room, seems to be these escalating geopolitical tensions, specifically between India and Pakistan.
Okay. That explains the risk aversion then. Geopolitical uncertainty almost always rattles markets.
Investors get nervous, right? They anticipate potential disruptions.
Exactly. Yeah. Potential economic fallout, trade issues. It makes people cautious, and they tend to pull back from equities.
Well, let's look at bonds and currency, too. The 10-year government bond yield, it closed at 6.85%. That's up 4 basis points.
Right. So yields are up. That fits the pattern. When uncertainty rises, like with this geopolitical situation,
people want safer assets.
Precisely. Demand for government bonds increases. Higher demand means higher prices, and bond prices and yields move inversely. So yields go up. It's the flight to safety playing out in the bond market.
Got it. Like anchoring in a storm, as you said. And the rupee, how did it fare against the U.S. dollar? We saw USDIR closing at 85.40.
A slight weakening there for the rupee. Again, pretty standard reaction.
Why is that?
Well, the U.S. dollar is often seen as the ultimate safe haven currency globally. When there's turmoil or uncertainty elsewhere, capital tends to flow towards the perceived safety of the dollar. Increasing
demand for the dollar.
Which can push down the value of other currencies, like the rupee in this case. It reflects that market uncertainty.
Okay, let's connect these dots more clearly with the top financial and economic news driving this. So these India-Pakistan tensions. We're hearing about military actions.
Yes, the reports suggest an escalation, and that immediately creates nervousness, not just politically, but economically, too. Markets hate uncertainty.
And that directly translates into market volatility. We saw the Sensex tumble today as well, right? Down about 880 points.
Yes, a sharp fall there, too. It mirrors the Nifty's drop. It shows just how sensitive the market is right now to this specific geopolitical news. Investors are reacting quickly, trying to de-risk their portfolios.
It's an immediate reaction. But interestingly, while stocks were down, gold was up.
Ah, yes, the classic hedge.
Gold prices in India climbed to 9,149.95 per 10 grams. That's the flight to safety we were just talking about, isn't it?
Absolutely textbook. Gold is seen as a store of value, something tangible when financial assets feel risky. So when fear rises, money often flows into gold, pushing up its price.
Makes sense. Now, stepping back, what about the global picture? Are other markets reacting similarly?
It's actually a bit of a mixed bag globally. You have some markets showing resilience, maybe because of, positive local economic news, or perhaps some optimism about trade talks in other regions.
So not uniform pessimism.
Not entirely, but there's definitely an undercurrent of caution everywhere because of various geopolitical risks, including the situation here. So while some markets might be up slightly, there isn't strong bullish conviction globally.
And locally, there's this projection now, forecasting a potential slowdown in India's economic growth, down to maybe 6.5%.
Yes, and that's being linked directly to the current situation.
How so?
Well, two main reasons cited are, one, potentially increased government spending on defense due to the pensions.
Which diverts funds from other areas.
Exactly, areas that might drive economic growth. And two, the potential for disruptions to trade if the situation worsens. Both of those could act as a drag on the overall economy.
It really shows how interconnected everything is. Geopolitics, market sentiment, economic forecasts.
It's a complex web, definitely.
Okay, let's shift gears for a moment.
Yeah.
While we're navigating these choppy waters, it's crucial to be aware of potential pitfalls, things that can harm your investments regardless of market conditions. Today, let's talk about something called churning.
Yes, churning. It's something every investor should be aware of, though hopefully never experience.
What exactly is it?
Put simply, churning is when a broker engages in excessive trading in your account. Buying, selling, but not primarily for your benefit.
So why are they doing it then?
Primarily to generate commissions for themselves. The more trades, the more commission they earn. It often completely disregards your actual investment goals, your risk tolerance, or your long-term strategy.
That sounds, well, unethical.
It is. It's a breach of trust and duty. Think of it like a mechanic constantly finding problems with your car, just to charge you for unnecessary repairs.
So how can you, the investor, protect yourself? What are the signs to look out for?
Vigilance is absolutely key. You need to monitor your account statements regularly. Look at the transaction history.
What should raise a red flag?
A very high frequency of trades that doesn't seem to fit any logical strategy. Trades you don't remember authorizing or that you don't understand the rationale for. Unexpectedly high commission costs.
And if you see something suspicious?
Question it immediately. Ask your broker to explain the reasoning behind the trades. If the answers aren't satisfactory or if the activity continues, don't hesitate to escalate the issue. It's your money. You have the right and the need to understand everything that's happening with it.
Really crucial advice there. Be watchful, ask questions. Okay, so wrapping up today's market picture, the downturn we saw, especially in the Nifty 50.
It really underscores just how much geopolitical events can sway financial markets and how quickly.
It's a stark reminder. So what's the key message for investors listening today?
I think there are a few key things. First, stay informed. Understand the broader context, like these geopolitical developments. Second, exercise caution. Don't make knee-jerk reactions, but be mindful of the risks.
And third,
Keep your focus on your long-term goals. Short-term volatility is, well, part of investing. Try not to let it derail your long-term financial plan. India's underlying economic fundamentals, despite these bumps, are still considered strong by many analysts for the long haul.
right, maintain that long-term perspective amidst the noise. Diversification and maybe keeping some liquidity handy probably wouldn't hurt either in times like these.
Absolutely. Risk management is paramount when volatility picks up. Diversification across asset classes and having some cash can provide a buffer.
And thinking about specific sectors, given the news, maybe defense stocks could see some activity. Infrastructure too, perhaps.
That's plausible. Increased defense spending could benefit related companies. Infrastructure might also get a boost from government focus. On the flip side, though,
Tourism, aviation.
exactly. Sectors like tourism and aviation could face headwinds due to potential travel advisories or just reduced consumer confidence during periods of tension.
So it's not uniform impact across the market. Okay, good points.
Definitely pays to look beneath the surface index number.
So as you navigate today's financial landscape, perhaps keep this quote in mind. It's from Henry David Thoreau. Wealth is the ability to fully experience life.
A good reminder of what we're ultimately striving for, beyond just the numbers.
Indeed. It puts things in perspective. And if you found today's discussion helpful for understanding the market dynamics,
Please do subscribe. We bring you these insights daily to help you stay informed.
absolutely, hit that subscribe button. And for more discussion or if you have questions, please connect with us. SOS FinWell over on LinkedIn. We'd love to hear from you.
We would. Thanks for tuning in.
Yes, thank you for joining us for this edition of FinWell Daily Brief.